This Spotlight on Investments is sponsored by Financial Independence Group. Our products are strong, but our strength is in our people. For more information, please visit figmarketing.com. Broker-dealer advocates are calling for a coordinated effort between the Labor Department and the Securities and Exchange Commission on fiduciary regulation. Several advocates spoke at the Labor Department's two-day hearing, calling for coordinated efforts in the creation of a standard of conduct for broker-dealers. The current proposed rule, which would also apply to RIAs, would eliminate the 5-part fiduciary test. It would change the definition of fiduciary to include anyone making recommendations on investing in, buying, holding, or selling securities, or anyone providing advice or recommendations on managing securities. Additionally, SEC staff recently released a report as part of the Dodd-Frank bill recommending the same fiduciary standards should apply to both investment advisors and brokers. Many broker-dealers are concerned that the conflicting rules will create problems within the industry. According to SEC spokesman John Nestor, the regulator plans to issue a rule proposal before July that will include the Labor Department's feedback. A Spectrum Group survey indicates wealthy investors plan to invest in stocks and stock mutual funds in 2011. About 52% of ultra-high net worth households say they will likely buy stock or stock mutual funds this year. In addition, 35% of wealthy households say they plan to invest in cash instruments, 33% say they plan to invest in international investments, and 31% say they plan to invest in fixed income products. The survey found 92% of wealthy households currently own individual stocks, and their average investment in individual stocks is $1.4 million. The Securities and Exchange Commission is looking into the registered investment advisors' usage of social media and social networking, say officials at ACA Compliance Group. A compliance alert on the company's site says the SEC is asking for documentation on how advisory firms are using social media sites like Facebook, Twitter, LinkedIn, YouTube, and Flickr, as well as blogs. The regulator is seeking information on advisors' policies regarding how their employees use social media and how firms retain records of employees' social media use. According to ACA's alert, ACA believes that the sweep on advisors' use of social media has been undertaken as a means for the SEC to review this evolving area. As noted, the requests are broad and will enable the SEC to evaluate how prevalent this activity is to registered investment advisors and whether it needs to dedicate further rulemaking and/or examination to complete a more regular and thorough evaluation of this activity. ACA officials believe the sweep is also investigating whether advisors are using social media sites to promise investor returns or engage in other illegal activities. For more industry spotlights, visit producersweb.com.